to kind of ask a question, and as we go, your feedback can kind of help me see where the sticking points are, and those are places I'm going to try to stop a little bit later on and try to see if we can get some sticking points out, okay? So our income statement is going to, that's the first financial statement we look at, right? So the income statement pretty much flows over into the what? Statement of retained earnings, which flows over into the, especially which section? Equals liabilities plus equity. So it goes to the equity section, okay? So our job, basically, part of our job in chapter 4 is to show how the income statement goes into the statement of retained earnings, which ends up in the balance sheet, specifically under here, okay? So we know for chapter 4, remember the difference between chapter 4 and chapter 5 is we're just talking about revenues and expenses, but chapter 5 is going to show us how to present that in a set of financial statements that we can make decisions on. So our general income statement is always going to be revenues minus expenses equals income. We agree on that? Okay, now, when we think about revenues, I'm going to move this over a little bit. When we think about revenues, with equity, we show an increase in equity with the credit, right? Anything that increases equity is going to be debited or credited? Credit. So when I have sales revenue, I'm going to debit or credit to show an increase in sales revenue? Credit. If I show revenues from car sales, what is it going to be? Credit, okay? So anything that increases equity is going to be credited, okay? So revenues. Anything that increases equity is credited. All right, now, if I increase something with a credit, how do I get rid of it? Excuse me, let me change that. For this chapter only, for chapter 4, anything that I increase, since I'm increasing revenues in chapter 4 only, and I'm stressing that, right? Chapter 4 only, to get rid of them, then I do what? Debit or credit. If I increase them with credit, then I get rid of it with a what? A debit. Now, I stress only chapter 4 because, remember, we have to put our income into here. We're used to just being given our beginning retained earnings plus or add income and less or subtract dividends equals our ending retained earnings. That was what we're used to. But now our goal is to take it from our income, and that's what it's supposed to be in there, right? So in order to do that, we did journal entries to get it in the income statement. So we're going to do journal entries to get it out of the income statement, right? Anything I did to put it in, I'm going to do the reverse. If I add something, in order to undo addition, I'm going to do what? Am I going to add some more? I'm going to what? Subtract. Anything I multiply, I'm going to do what? Divide. Anything that I increase with the credit, I'm going to decrease it with the what? With the debit. So, in order to get my revenues out of here into here, previously now, what we did in chapters 1 through 3, we just took this number and put it in. Now what we want to do is we want to take it off the books. So, I previously increased it over here with the credit, so now, DR is going to stand for debit. In order to get it out, well, to remove revenues, I'm going to debit, that just stands for debit. I'm going to debit revenues, and I'm going to credit a new account. What's the new account called? That new account. We got to know this new account, because that's the only way we're going to be able to get it out. We previously put it in as revenues, but we're going to get it out by crediting what account? Expenses. Not expenses, but we're going to work with expenses, but not expenses. I know what you're thinking about, so you're on the right track with that. But let me ask you this question. When you credit expenses to get them out, what's the account that you use? Almost. We think that's chapter 5 there. But you're on the right track for chapter 5. What we're doing is the closing entry to get it out of here. Now, you on the right track because you're talking about expenses. Think about it. When you credit expenses to get it out, there's another account you have to debit. What's that cost? It's gonna be the same one for revenues. It's 2 words. That's last. Something is going to go into retained earnings. Once you get this word or this concept, then you can do all of this to get it there. So it's 1 word we did, or 2 words we did, which is 1 phrase. Income summary. That's right. Income summary. Same account. That's what you were thinking about. Okay. Same account. Income summary. Now, why are we doing this? To remove our revenues from the income statement. To remove our revenues from the income statement. That's why we're doing it. Does it make sense though? Let's make sure it makes sense, right? If I increase it with a credit, I'll remove it from here with the what? Help me out. How do I remove it? With the debit. That's right. Be confident in it with the debit, okay? And if you see, I debited to get it out of here, off my income statement. My goal is to get it here, but I must go through this little tiny little vehicle right here to get it in, okay? Can we keep going on that part? Now, with expenses, anything that we use to decrease equity, we're going to do what? Debit or credit? Debit, right. Because remember with equity, I increased my equity with a credit. So if I want to decrease my equity, which I do with expenses, then I will do so with a debit. The plus on this side. We remember those, right? Debit salaries expense, pay cash, credit. Debit salaries expense, pay salaries, pay them later, salaries payable. We remember that, right? So in order to get rid of all of those, and why are we getting rid of them? Because we used to would just take this. Remember, we used to just write this in here, but now we have to show how it gets there with the journal entry. Okay, it's kind of like carrying the one to show your work. We know you know how to do it, but just to make sure, we want to basically carry out one or something like that. Okay, so we're taking expenses off. We decrease equity by debiting expenses, so we lower equity by doing what? The opposite, which is to credit. That's right, okay? So this case, we're going to credit our expenses. And now we're taking them off. But they need to get in a vehicle to go from here to here. What's the name of the vehicle? Is it a Ford? Is it a Lexus? Is it this vehicle right here? What's this one called? Income summary, okay? So we have to put it in income summary in order to take it from our income statement all the way over to our statement of retained earnings. Okay? So at this point, how much do I have in my income statement? Since I've zeroed out everything, how much do I have in my income statement? 0, right? And that makes sense because when I take it out of here, it's going to all end up over here. I don't need it in 2 places, right? So that makes perfect sense, all right? Now, I want to take these accounts, same one here, and I now need to put them in a statement of retained earnings. So, how do we show, this is provided I have a positive balance, okay? So, if I have a, which most of the time, we're going to have a positive balance, okay? If I have a positive balance, then this is what it means. It means that my income increased it, and anything that I increase will retain earnings. Remember over here, if I increase my retained earnings, we're going to go to retained earnings. Still following the same concept, right? How do I show an increase in retained earnings? Equity, anything under equity increases with a credit. Does retained earnings usually increase it? So that means I'm going to do what? Credit. So what I want to do is I want to take my income summary and now take all the people out this vehicle and I want to put it in my retained earnings account. we know that retained earnings is going to increase with the credit. So I may as well go ahead and write that there. Retained earnings. That's with the credit. Retained earnings is credit. Credit retained earnings. And then all I do is just take the difference between this right here, and we know that it's, if we had positive income, we know it's going to increase because of the add. And so all I do at this point in time and now is just debit or do the opposite of what I did to have income summary. And now it's ready to go into the retained earnings. This is how it gets there. This income, I'm going to put it in green because I want us to make sure we see now. Anytime we have this green, hopefully anytime we have this green right here, it represents our income summary, right? This is that same income. And you take it, you go from your income statement, you put it in a vehicle, little tiny vehicle named income summary, and then it ends up right there. Okay. Everybody like that? Sound familiar to you, right? Just got to practice a little bit more. Okay. So everybody good with that? Now I want to make a point because he brought up an excellent point. What he was thinking about was sales, returns, allowances. He's thinking about chapter 5 when someone returns something. So he was correct now, but he's already thinking ahead of chapter 5. So we'll take care of that in just a second. But just want everybody to know that he was exactly right on that. Everybody good on that. Eventually, this is going to end up right here in our retained earnings. I'll put them in red so we can see what has to do with what. Okay. Does that make sense? All right. Can I erase that to continue? Any questions before we go? You may have some later, but any questions right now? Yes, sir.
So below the income statement, that is the journal entry for moving it over, right?
Yes. All of this, I'm going to use red here because it's talking about retained earnings. All of this right here, these are journal entries to do what?
To take the income statement.
Remove, that's right, remove from the income statement. And, you have to have both of them, to put in the retained earnings statement. Okay? So that's all that's necessary. And what we want to do is we want to zero this out. Previously, we used to be given this number. All we're going to do now is just compute the journal entries to show that now I know what goes in there. And then remember that it ultimately ends up right here. That's the final destination for it. Okay? So what he was making sure, he wanted to make sure that why do we have these? These are what you call the closing entries to close out or to zero out our income statement so that now, think about it like this. Next year, what if next year on day one, think about it like this, on day one now, which, let's say today is day one of the business. We previously did some work last year, right? On day one, have I sold anything at 12 o'clock midnight? Have I sold anything on this day? No. Have I had any expenses at 12 o'clock a.m. on that day? So if I left this stuff in here, imagine you come in and where all this stuff come from? You see what I'm saying? So we need to zero this out so that we can start over for this period. So then for a whole period, because remember, it's always for the period ending at some point in time, we can know that everything we have in here is for this current period, okay? So that's another reason why we're zeroing it out. Okay, everybody good so far? All right, now I'm going to go to the accruals, and we're going to talk about them in the context of the way the question was asked. Okay. By the way, accrual interest must have at least one of these type of accounts. What are those? At least one what? One balance sheet account and at least one income statement. If you have two of the same one, you already know you are right or wrong. Wrong. And you want to know that right before you finish it, okay? So it's kind of a way to check if we want to say it right now. It's a way to check it, okay? Now, accruals. Must have at least one income statement account and one balance sheet account, okay? Okay, one income statement account and one balance sheet account, okay? What's an example of an accrual entry? Just think of one right fast. Just give me any one that comes to your mind in terms of what an accrual entry is. What's your favorite one? If you give me an example, then I can work your example, I can work it with you, and you'll get even better understanding. So if you give me one, I can do any one, but I want to make sure that I do one that somebody really likes, okay? So let's take any accrual entry. Which one you have for me?
It's just the sentences, like the failure to record revenue recognized.
That's okay. Give me one that you have the most problem with. Yeah, whichever one. It could be the first one. I think I want to do a last one as well, but give me one of the first four that's in there.
Failure to record accrued interest on a note receivable.
Accrued interest on note receivable. Because we have it going to chapter 4, the way I want to break chapter 8, the way I want to break that one down is a little bit more different, okay? I want to be able to break it down because we haven't talked about the difference between notes receivable and accounts receivable. So I want to do, I should have said anyone other than that one. Anyone other than that one I want to be able to do, okay? Because I can really break it down a lot more when we get to that chapter 4, you know, otherwise I have to introduce some new concepts. I'm sorry about that. That was probably number 3, wasn't it, if I remember?
Yeah, that was 3.
I remember.
What about failure to record expired prepaid rent?
That's a good one. A failure to do prepaid rent, okay? Let's think about it. January, February, March, March the 17th, right? So March 17th, we call it March 15th. All right, so we paid up our rent before the beginning of the semester, right? For January, February, March, and April. We agree? So we paid up our rent, and when we paid up our rent, we prepaid it by giving the apartment manager some what? Money, and we think of that as cash, right? And so we're gonna say we debited cash, and we credited cash because we gave away some cash. I'm just gonna put a C off for credit. And we debited what?
We credited cash and we debited rent.
Almost. That's coming on the accrual part. What's the other count? Think about our current assets. What's our current assets? Overall, cash, receivables, and inventory, supplies, and prepaid, because we prepaid it, right? On January 1st, we prepaid rent, okay? And that is a debit. Now, notice, I said prepaid rent. I did not say expense because we don't have an expense yet, okay? So we prepaid our rent for, let's say, how much we gonna use for our apartment? Where we gonna live? The price you give me is what we gonna pay. Is where we gonna live. So what's the price per month?
$800.
$800. That's pretty good. $800. So 8 times 4 would be $3,200 for the first 4 months. So $3,200. And this is for 4 months rent, okay? For 4 months rent. So that was in January. Now, remember what an expense is. Like I say, they don't make us do this, but we have to remember what an expense is. An expense is part of is a using up of assets or an incurrence of liabilities. Now, there's a little bit more to that, but for our terms, for our purposes, the pure definition is a using up of assets or the incurrence of a liability, okay? Now, this is an asset. And how do we use up prepaid rent? By actually living there, correct? We actually use up by living there, okay? Now, This is for, don't think of this in terms of numbers, think of this in terms of months, okay? January the 1st. After the first month, at the end of January, have I used this apartment for 1 month? We agree? You paid on January 1st, you move in January 1st? Yeah, that's okay, I probably should have asked it differently. On January 31st, at the end of the month, I've lived there for a month, right? Which means I've used it. So, this is an asset. You can think of this as an apartment, but think of this asset as an apartment. I use this up for 1 month, okay? Now, before I do any journal entries, remember, this is for 4 months, right? So every time I look at this, I'm thinking about how many months of rent I have paid up in advance. This tells me I have how many months paid up in advance? 4, okay? Tells me I have 4. At the end of the month, do I have 4 months paid up? No, because I already used 1 month, right? I already used 1 month. So, if I forget to account for this, and I look and I see that I think I have 4 months, then what I'm really saying is, oh, I have 4 months. And this account will have more in it than it would need, which means it would be overstated. Right? So if I forget to put my prepaid rent in, then every time I look at it, let's say if I look at it today, now 2 months have passed by, so that's 2 months. I should only have $1,600 or maybe less than $1,600 in there right now. So if I look at this today, and I haven't made any interest for January, any interest for February, then this account is what? Over or understated? Overstated, because it's showing that I have 3,200 when I should only have 800. So if I fail to update my accounts, in this case, prepaid, only for this case, okay? Only for this case, prepaid. Let me write a different color. In this case, prepaid, then my account is wrong. This case, if I fail to update my prepaid, then my account is wrong because it is what? Overstated, okay? Because it's overstated. So the key is to say, if I forget or if I mess up, say if I accidentally did rent expense, I was supposed to update this one, so if I never took it off, I'm still showing it as March the 17th. I'm still showing I have 4 months, and I'm wrong because today is March 17th, and I haven't done anything. So when it's asking if it's overstated or understated, what it's saying is if I forgot to do this, then this is what happened. Okay. I think there's one about supplies. Is that correct? Number 1.
The one about supplies. Failure to record revenue recognized but not yet received.
That's one to do with supplies.
I don't see it.
Oh, that's okay. I think take that one. Let me take that one. No, that's okay. Which one? Read it again, please.
Failure to record revenue recognized but not yet received.
Failure to record revenue recognized but not yet received. Okay, gotcha. We're going to use this part again. Okay. Let's just say I have accounts receivable, which this is accounts receivable. That is, we record that. Why? When you have sold something, you made revenues, but you have not yet received the cash. We agree on that, right? Okay. I hope I remember this correctly. You said failure to do what now?
Failure to record revenue recognized but not yet received.
Okay, gotcha. This journal entry says that I Let me change this up. This entry says, I expect to receive revenue in the future, okay? Let's just call it $300 worth of revenue. So I expect to receive $300 in the future. That's what this says, right? So whenever you see accounts receivable, that means I sold something to someone. That means I fixed somebody's bicycle, I did whatever it was, and I did it. Think about this situation. We're talking about right now, you just finished doing a job for someone, right? Right now you just made a sale. I don't see anybody right now doing their accounting books, right? Because you're doing something else. Even though you probably shouldn't be making a sale, you got to make the money, right? So you can't make the sale right now. Right now, you did just finish doing whatever transaction you need to do, right? We agree? Have you recorded anything yet? So think about it. Way down 98, that's where your business is. Now, when they look at the books, they could be on the phone with somebody and say, how many sales did they have this past month? Let's change this up a little bit to 30,000. They said, oh, we only had $10,000 worth of sales, not knowing that you have just completed a $30,000 transaction, right? You just completed $30,000. The last time they checked, the last time you did the books, it's still saying $10,000. So in this case, because this is an entry that says I expect to receive revenues, if this is not in here, then are my revenues, or in this case, are my accounts receivable over or understated? Are my accounts receivables over or understated? Understated, because you just finished this, but it's not in there yet. It's not that they're wrong, like physically, you just haven't had time to pick up the phone and call. So at this point in time, your receivables, an accruable account will be understated, okay? Now, it is only talking about assets in this case, but let's think about the revenues. If I fail to record the revenues, then are my revenues over or understated? Remember, the books are showing 10,000, but you literally just finished that transaction. So you haven't had time to call them, text them, email them, and say, hey, put this in there. So at this point in time, my revenues would be what? Understated. So now, let's go back to the original question. Accounts receivable, we agree, is understated. So if I fail to update my accounts receivable, then my account is going to be understated. Okay?
So a way to kind of see them both is that normally with understated things, it's stuff that you have not received yet. It's stuff that would be liabilities. But with the overstated, it's something that you failed to like edit or failed to put in there.
In terms of the assets, that sounds to be right. But remember, this one is only talking about assets. So you can get to some, we're talking about this one. We can get to others like, I'll say with the interest to really explain it, I need to explain that, and also accumulate depreciation. So if I forget to do accumulate depreciation, that's going to have a different context. But in terms of just the assets, that sounds very helpful. Okay, so think about it only in terms of assets. But remember, it's a two-sided account, so something else is going on, even though we're only asking for assets. That's why I like that one better, because it forces us to think a little bit more. The other one just reminds us that we have two accounts, but this one only says we only have one. And you can think, when you come to anything prepaid, to anything that has to do with accruals, I always think if I forget to update my, you fill in the blank, then my account is going to be this right here. And think of some scenario where it happened. Does that answer your initial question at first?
Kind of.
Okay, what else you have on that one?
I didn't understand the no effects fully, or the failure to record accrued wages and a failure to recognize a portion of unearned revenues.
Okay, what was the first thing you said? I think it was accrued to do wages.
Failure to record accrued wages.
Okay, so with accrued wages, that would be salaries payable, right? So I didn't get a chance to record my salaries payable. Is this in the same one or this another? It's the same question?
This is the same section.
Okay, that one I believe has no effect for the answer? Good, okay. That goes back to what we were talking about earlier. I forgot to record my salaries payable. And this is one of those where, you know, we have to think about what it's asking. So I work for you, and there should have been a salary expense in the book. And there should have been a salaries payable, right? We agree that should have been there, right? But what happened? I failed to update my salaries payable. I also failed to update my expenses. So my expenses are off, my liabilities are off. The question asks what?
It just says failure to record accrued wages.
Which, going back up, it talks about recording our assets, right? So the reason we have no effect is because expense generally falls under your equity, and your revenues generally fall under your liability. Your salaries payable generally falls under your liabilities. So that's why there's no effect on that one right there. So it's forced us to go back and say, which ones are these? This is an asset, this is an asset, this is an asset, this is an equity type. It's making us go back to remember where we are. Okay. So in general, that's what we have in terms of our accruals. All right, so let's check out some income statement material, okay? Is this helping in terms of some different things you may have thought about, okay? Now we're in chapter 5, so we think a little bit different. If we record a sale and we forget, if we record a sale and someone returns something, how do we take the revenues off the books for that? With a debit or a credit? And to what account?
If we are taking something.
You sold me something, I return it. You can't keep those revenues on, that won't be fair, right? So that means you have to debit or credit something to take the revenues out. What would that be?
You debit sales returns and allowance.
Right, because we what? We what with the revenues? We do what?
Credit.
What's the emphatic statement we made last week? We never debit the revenues on that one. So let's see. Assets equal liabilities plus, let's come over here, equity, write this whole one out. Let's remember, anything that increases equity is done through a credit. We know that revenues increase equity with a credit. So anything that decreases equity is done through a debit. Now, that means that sales, return, and allowances is going to be debited. Why? Because this removes revenues for returns. What if I have a discount? Then sales discount is going to be debited. It's going to be debited to show all of my discounts. Okay. We also talked about when do you pay the freight, right? So we talked about FOB. What does FOB mean? Free on board. Now it's just a matter of where it's going to be. So we are buying some stuff. This is, I think we were the sellers on this side, right? We were the sellers, so we're selling things, right? Free on board talks about a lot of things, but in this case, mostly who is going to be responsible for paying the freight. So the airplane is here. When we get to right here, it's about to go up in the air. So I am now off the ground, right? If it says free on board shipping point versus free on board destination, let's think about it. This is the shipping point where it just left, right? This was shipping point here, and now it's off the ground. Who's responsible for the shipping? If it's free on board shipping point, then who's responsible for the shipping? The seller or the customer? I mean, the seller or the buyer? If it's free on board shipping point, who's responsible?
The seller.
Y'all gotta let me know for this plane. I'm about to crash my plane. It's going to be the seller. Free on board, I mean the buyer. It's free on board shipping point. Once it left, free on board shipping point. Now, what if it's free on board destination? That means that from the time it gets in, if the plane does something funny right here, we're still responsible for it, right? But it's recovered, right? And so now we can go over here, and anytime before it lands, anytime before it gets to destination, we're here. Now, why is it important? Because if it's free on board shipping point, that's the destinations we just finished. If it's free on board destination, that means that we are responsible for the cost. So if we're responsible for the cost, then we record, let me put it this way. If we are responsible for shipping, then it is a freight expense to us, okay? And of course, we may pay cash with that, right? But if the customer is responsible, then the shipping is part of their, in this case, maybe inventory or supplies or whatever it is, usually going to be inventory that they're going to order. So it's important that we understand, because if we, the seller, is responsible, then we're going to charge to freight expense. That makes sense, right? We want to go back and review. Man, well, I mean, just think about it. You know, the shipping and handling is going up for a lot of stuff. When gas goes up, shipping and handling goes up. Somebody got to pay that. So we're going to look and say, well, maybe we can shift from airplane to maybe all ground shipping. Okay, that way we can go back and think about cutting our costs. In this case, whenever we buy something, all we know is we just pay our transaction fee and that's it. We let them be responsible for where it goes to, okay? So that's the reason it's important that we understand whether it's free on board shipping versus free on board destination, because that determines, number one, who pays it, and then what type of journal entry we have. Everybody good with that part of review? I think we had an excellent review. What about you? That just went up from taking the test. We take the test Wednesday, right? So we just increased our grade by how many points? 10. So you can go in there. If you go in there and take it, and I give you 10 points, you just earned 10 points. I think we said we went from a D to a C. Now we at a B. So all y'all got to do is go home and get the A, right? Feel good about it? All right. But I know you got more questions, right? You got some more questions?